friends, Louie here, and I saw this great article off of Zillow called Five Things to Know About Investing in Single-Family Rental Homes. I know many of us have this as a goal to have our assets work for us by buying investment property to turn around and rent to other people to have your cash start producing income. And of course, I'm watching the real estate market very carefully and seeing all of the signs that I had predicted when we started talking about this new tax plan here in my blue state, which is California. So I am not currently in the real estate market. I'm waiting for a buying opportunity, which I think will be right around the corner. But you may be in the real estate market or want to go ahead and do this, and I thought this article was quite good, so I'm going to read it to you. This is by Gary Beasley, and it opens up by saying, let's go right here. Single-family rental homes comprise more than 1/3 of all U.S. rental properties, about 16 million currently, with another 13 million new rental households expected to be formed by 2030. Since U.S. housing stock is not keeping up with this future demand, the sector should enjoy a significant tailwind given these favorable supply and demand trends. Not surprisingly, demand for single-family rentals is at an all-time high and showing no signs of slowing. I'll stop there for 1 second. I have, having sold my primary residence last summer, I am in this rental market, and it is a tough rental market, especially trying to find a home. The home that we just secured in Southern California, there were, 4 or 5 other families that wanted it. So I was very happy that we were able to secure that. Tough to find affordable rental housing. And not that it was cheap, but it was at least affordable. There are many attractive characteristics to the single-family rental asset class. For starters, returns have historically moved independently from the stock market, meaning they lack correlation. In fact, data compiled by my company, Roofstock, show that single-family home prices and stock prices are almost perfectly uncorrelated. This means that ups and downs of the stock market have almost no direct impact on home prices, which tend to change in value more slowly and be influenced by numerous factors such as the strength of the local economy and amount of supply added. If you're a newcomer to single-family rental investing, one way to think about it is like an inflation-adjusting bond with an equity kicker. The rental income less operating expenses generates current distributions. Like the coupon on a bond, and rents can be adjusted annually, providing inflation protection. Finally, the equity kicker comes in the form of building wealth as your tenant pays down your mortgage for you while your property can grow in value over time. It's entirely possible to get a nice double-digit overall return on your equity over an extended holding period. All right, I'm going to stop there for a second and just issue a warning. So this obviously can work well, when the investment is a reasonable and modest amount of money. Let's say at the national median value of a home, which is 200 and something thousand dollars. When you get into the high-flying blue states, you could be looking at hundreds and hundreds of thousands, even $1 million for such an investment. So I do think the risks grow as the size of the property increases, because what happened in the last recession, which I think will repeat, is people started to go negative on their equity when they put a bunch of money into these homes. And a lot of people gave the homes back to the bank because they were paying a mortgage on a house where the debt actually exceeded the value of the home after a recession hit. So I'll throw out that caveat, which is something that keeps me from buying a house at this moment. And purchasing and owning a single-family rental home is simpler than you might imagine. Here are 5 tips to get you started. 1. Know your investing criteria first. With any investment, be it stocks, bonds, or real estate, you need to know that what your objectives are. If you're focused on safety and security, consider exploring low-risk investment homes that generate steady, reliable yield. An example of this might be an example of this may be a more expensive investment property in a good school district. You're going to get a lower yield, but you may see better downside protection and less volatility. If you have a longer time horizon on your seeking higher returns, you may want to take on a little more risk. Often lower priced homes will be riskier, but you may get higher yields and potentially higher long-term returns. 2. Don't limit your investment property search to where you live. I don't know that I agree with this. Consider this. If you live in Atlanta, you wouldn't buy Coca-Cola stock simply because its headquarters are local. The same principle applies to real estate investing. If your primary residence, income, property, and job are all located in the same area, you have a lot of concentrated risk and are more vulnerable to the swings of the local economy. At Roofstock, an online marketplace for buying and selling leased single-family rental homes, we encourage people to spread risk by investing in markets outside of where they live. Hiring a local property manager is key. So there you are with hiring a local property manager. I think many people will want to be the property manager themselves and save that income and also give a personal look at the home that they have much of their savings tied up in. So I would personally not want to be hands-off on rental property, especially if I only had one or two. If a wealthy individual had a fleet of rental properties, then of course you'd have to have someone to help you manage that. Diversification is just one reason to expand your investment property search. Another is access. If you live in an expensive urban or coastal area with relatively high home prices, San Francisco Bay for instance, finding an income property that is cash flow positive is going to be challenging, to say the least. 3. Separate investing from operations. One of the appeals of investing in single-family rental homes is you can hire strong local property management firms to handle day-to-day management tasks of rent collection, repairs, and maintenance and leasing. All right, this is another advertisement for property management, and you can make your own decision whether you think that is worth the money to hire a professional to do that for you. I could see a lot of advantages, but I could also see property managers missing some really, really important red flags that you might want to be aware of if you are hands-off on your property. 4. Real estate investing is a marathon, not a sprint. You might be familiar with the house-flipping reality TV shows in which a person buys a home, fixes it up, and sells quickly for a profit. While that can be an effective way to make a one-time profit, it's the exact opposite of how you should approach single-family rental home investing, which is about building long-term wealth. Instead, treat it like a nest egg. In addition, don't be overly influenced or reactive to short-term fluctuations in your rental property portfolio. You may own a home for a few months and have to deal with a tenant moving out unexpectedly, but the next tenant might reside there for several years before you have another vacancy. Look at this investment over a multi-year horizon and consider your overall outlays and inflows over that long time span. If you buy a decent house in a decent area, the returns tend to be quite attractive over time and can add a nice counterbalance to other types of investing. All right, I'm going to add one other perspective here, which I think people tend to forget about, and that is if you're looking at a long-term perspective, be brutally honest and conservative about the cost of repairs and major improvements and just repairs to your home. The cost of the trades, especially in higher flying areas, dense areas and higher cost areas, the cost of the trades, the plumbers, the electricians, the roofers, the contractors, are going up so rapidly that, for example, in my neighborhood, painting could be, the outside could be $10,000, $20,000 or more. Did you know that workers' compensation in California, can be a gigantic proportion of what the contractor has to pay right off the top? 5, 10, 20% of every payroll dollar. So be careful to properly estimate what you think the long-term improvements and long-term repairs might be to your home. If you're in a low-cost state, I think you have much less to worry about. And 5, take advantage of tools and resources available to you. New developments in technology and data access are making real estate ownership more broadly accessible to the everyday investor. I will put the link down below to their website, but I do think that the single-family rental market is an excellent way to build equity and have someone else make your mortgage payment for you. If you're in an area where you can cash flow, where you can be positive, and you have the investable cash, it's always a good idea to have your cash working for you. So in terms of buying, renovating, flipping, and relying on market appreciation to break you even, I would be much more careful and considerate about that. I think the market is at a top. I'm seeing signs of it everywhere. And finally, you will see it on major news sites that things are looking very toppy. When you watch, I follow Zillow quite a bit, and when you watch the price of homes start dropping 50, 100, or $150,000 below the Zillow estimates, you know that there is some kind of turnaround in play. Also, when the tax codes have been changed to disfavor high-income properties, that will have a negative effect, certainly in the high-flying areas at a minimum. But if you are of the mind to look at this in the long term, and you can keep your investments within your within your risk tolerance, absolutely great way to secure your future and have your money work for you. Certainly beats a 2% return on a bond. All right, guys, this is Louis signing out. Please, I look forward to hearing your thoughts on whether you currently own a rental property, whether you want to own a rental property. How are you saving up the money for that down payment? You know, there's PMI and so forth. Are you concerned about how toppy things look? Are you waiting to buy like I am? I think a year or two from now will be a much better opportunity for entry if interest rates don't go through the roof anyway. And even if they do go through the roof, once you buy the house, when interest rates come back down, you can refi. So I think it is possible to purchase a house with a higher rate mortgage and come back around later and refi if the rates drop again. Certainly, if we drop into another recession, while rates may be higher at the peak of the recession, they will come down as governments intervene. So just some thoughts for you.